If trading feels confusing, overwhelming, or like you're just guessing, I get it. I spent 5 years stuck there. But once I focused on one simple scalping strategy, everything changed for me. I took a small trading account, built it up over time, and at one point I made $10,000 in one single month. And it's not just me, I've helped other traders use this exact process I'm gonna show you to become consistently profitable too. So in this video, I'm gonna walk you through the ultimate scalping roadmap. The exact steps I would follow if I had to start over from scratch today. Now we're gonna go over a lot in this video. I'm gonna build you a foundation of core skills to understand and analyze the markets. Then using those skills, I'm gonna show you the trade entry checklist I and other traders use every day to find profitable opportunities. Finally, we'll apply all of it with a real trade I made over $1,500 with this morning. And then by the end of this video, you're gonna be max level, ready to take on anything the market throws at you. So let's start at stage one and get you started on this process of learning to make money trading. So when it comes to scalping, the basics of how it works is you are looking for short-term swings or trades in the market. You are never looking to hold something long-term overnight. You are generally trading using 1-minute charts, 2-minute charts, or something like a 5-minute chart. The trades you're in are generally just a couple of hours at the most, but can even be a couple of minutes. The whole idea is that you are watching the market with a microscope and you are looking for high probability setups where you can jump in right at the correct time and then jump out when the market shifts to not being worth it of staying in anymore. You are not looking for massive home runs, massive big swings in the market that go over days. You are generally day trading and looking for quick moves in the market and then being done with the day. Now, there are some major mistakes that a lot of beginners and traders and myself do when it comes to scalping that really makes it hard and probably impossible to make money consistently. The first one of those is using bad risk reward ratios. Let's say you enter a trade here and your stop loss is down here and you're risking $200. And the most you hope for is $100. Well, at a glance, it seems like that's very easy to hit your profit of $100 very often. But what this does is over time, the math plays out and it's very hard to consistently make money doing that. An easy fix of this is flipping this. Instead of risking essentially 200 to make 100, you risk 100 to make something like 200. You don't have to be right as often, but you make more money when you do, and when you lose, it's not as big of an issue. The second mistake is going for tiny moves in the market where you enter in here and you get out right here. Again, it may seem like it's very easy to hit your profit target, but in the long run, what you want to be doing is focusing on those high probability areas where the concepts that we're going to go over line up and create a checklist for you to follow where the probabilities of you being right skyrocket. And so you can get in near the lows of, let's say, a swing and then jump out when that swing is kind of done, and you can get out with a really good profit and a low risk. And then the third major mistake, and I've fallen prey to this and I think everyone does, is trying to capture every move in the market. It may seem really simple of a concept, but when you're looking at a chart and you're trading, it's so easy to think, okay, I'm gonna jump in here, I'm gonna capture this move, and then I'm gonna catch it on the flip side for a little bit, and then I'm gonna jump in and capture the swing up again. And looking at charts, you can see these kind of potential moves all over the place, where if you think, okay, I'll capture this swing, capture this one, capture that one. And when it comes to trading, that is really impossible to do, and you'll drain yourself and become fatigued and make bad decisions really, really fast. When instead what you want to do is have something like my entry checklist I'm going to show you, where it increases your probability, where you say, I'm only looking for this specific thing where, 5 things show up, and the market doesn't do this very often, but when it does, it makes a massive move that I can capture and make a really big profit from. It's not about taking 10 trades in one day. Just because you're scalping, you can be taking 1 trade a day, even 2 trades a whole week, and you can still be consistently making money day trading just for a few hours a day over the long run. That is the key to becoming successful at this. Now, before we dive into chart patterns, if you want to follow along with everything you're about to see, from chart setup to trade analysis, I highly recommend getting NinjaTrader. It's the platform I've used for all my trades for over 5 years. You can get it here via this QR code or in the link in the description. So let's go over the 3 most powerful market structure patterns I've used and seen over time. This is probably the most important part of this entire process, and yet most traders actually skip over it and just search for an indicator to tell them when to buy or sell. But if you can understand this and these patterns, it will work way better than any indicator. The first major thing you need to master is analyzing just the basics of a trend. Now, when you first initially look at a stock chart, it looks all over the place. There's massive moves up, moves down, sideways movement, and the best way I have found to simplify this and analyze what the direction of the trend is to look at the major swings that you see. If we just look at this move in the market right here, you can see that just kind of blurring the candlesticks together and just making note of the major swings that it's having is you just look at where those highs and lows are in relation to one another. And so a downtrend like this one is signified by the highs getting lower and lower over time, and then the lows as well getting lower and lower over time. And so that's how you identify a downwards trend. It's super simple, but using this concept, you can then also say, okay, well now, right here, you can see it starts to switch, right? It starts to go kind of sideways. And that's essentially where a sideways trend is, where the highs and the lows are roughly the same. It doesn't have to be exactly at the same price. You can have a sideways trend that is like this, where it's still kind of all over the place. But if you look at it as a whole and not zoom in on the specific candlesticks, it's generally the price over this time is going sideways. That is the biggest key to focus on. And then an uptrend is signified by the opposite, where it's consistently making higher highs and higher lows, where the highs are essentially breaking above the high of the last one. And then same thing with the lows, is over time they're consistently getting higher. Now, you don't want to get bogged down in all the little micro highs and the lows it has. The key is you want to be looking at kind of the major swings that it's clearly having. That's going to tell you the trend and the direction that it's going to go. And with these trends is you can have trends that are very fast paced going up, or you can have ones that are a little slower, where they're kind of just slowly chugging along in that direction. There's not just one size fits all. Now, the second thing we've got is a way to help read these trends and easily understand what they're doing are using trend lines or channels. You can visually notice that the lows are consistently matching along the bottom if you draw a line touching the swings. And so for an example is here, if we look at this trend, this is a little different than normal. Usually you would say, okay, for a downtrend, I'm gonna match the highs here, but the trend up here breaks before it, consistently shows more. One thing you can do though is on the other side, you can say, well, the lows here are consistently matching where it bounces off these two. I can draw a line off of just 2 swings. That's really what you need to confirm it. And then you can see by this third one, you could see that it was gonna bounce there. And then where it came down here a fourth time is it was pretty helpful to say, okay, that's where it's bouncing off of. And then what you can do actually is you can take this and move it to the other side, and if it's in a good channel, is the other side will bounce off of it when it hits that area. As you can see here, it actually bounced this off of it initially, and then it eventually broke that because the trend changed and the trend channel broke. We'll get into a minute on those signals and kind of how you can use those to predict where the trend's gonna go. But essentially, when you're just looking at moves in the market, it'll help a lot to visually be looking for them. That's why I suggest when you look at a chart, practice and visually be thinking about, okay, where are potential trend lines that show me where the trend is going and what it's doing. Now, on the flip side, you can also do this with horizontal levels to show where supply and demand is. And these are essentially horizontal support versus trend line or trending supports. And these supply and demand zones are very helpful in a more sideways trend because you can predict, okay, based off of these two swings here, and I like to actually use a box instead of a line because again, the market never hits an exact price. It's always just kind of, well, up in this zone, in this area, based off of these two swings, I'm gonna expect if it comes down and pushes up here again, well, we might lose steam a third time and I can take a trade off of that. And so that's the basics of how those work. And so when you kind of zoom out, you can see actually big picture here is that if you look at the larger trend of the major swings, and you can always go to a higher time frame chart to kind of make this easier, is that, well, there's clearly a supply zone up here where every time the market comes up here, it bounces. And you could also do that for the lows here, is every time the market comes down here, well, there is a bounce that the market has. Now that you understand what these three major market patterns mean, let me show you how to use them to predict what the market's gonna do. If you've ever felt like trading didn't click, this next section is really gonna bring it all together. So if we go back to each one of these, if we look at market structure, well, the basics of using that lower highs and higher lows, well, as soon as you start to see a shift of a higher low and a higher high, right here, you can start to say, well, the trend is starting to shift. This is a signal that the trend is slowing down from a downtrend and starting to move into either a sideways trend or an upwards trend. And so through that is your first major indicator for seeing a trend potentially change. And you can use that to capture potential reversals in the market. Now, if we take that and add that onto using our trend lines or trend channels, you can see that, okay, well, once this trend line is broken, that's a second confirmation that this downtrend is coming to an end. And we can expect that it either starts to slow down or we can take a trade and capture an opportunity in the market. That's the whole idea with these concepts, is you're starting to build a foundation to have things align up all at once and to create a highly probable spot where you're correct about what the market's gonna do next. So often it is so hard to really know what's going on in the market. And so that's why you don't want to be trying to take every trade in the market. A lot of the times things are kind of crazy in the market and you want to wait until it's very clear and you have a clear understanding, so then you can risk taking a trade and putting your money on the line to take a profitable trade. Now, there's a couple ways that actually a trend line or trend channel can break. Now, another one is where it overshoots the channel, where instead of bouncing off the bottom of the channel here, it breaks through the channel and essentially gets overextended, oversold, and it will then reverse based off of that. And so those are two ways to look for the trend shifting based on a channel break. Now, the next thing is looking at your supply and demand zones. If I went here, had this pattern here show up, I would have thought, okay, this is a good spot to look for the market to reverse. It's come up here multiple times. The uptrend is clearly broken, especially after this sell-off. And so if we come up here again, I want to look for it to reverse again. It's a good spot to look for that to happen. And so going into this, you can see that if I put this box at the extreme high here, the market here actually broke the high of this area. And so when I first started out trading, I thought, okay, it broke the high, it's making new highs, and this supply level is broken. the market's, showing that it's super strong, it's had this massive move up here, it's probably just gonna continue trending higher. And so I'm not gonna look for a potential short here to bet the market's gonna go lower at this level that I've clearly identified before that is potentially a good spot for it to happen. And so instead though, knowing what I know now is a lot of times what can happen is it's a failed breakout. The market likes to pretend to break these levels in the sense of it likes to make, noobs like I used to be think that, okay, this is gonna go long here, maybe I should buy here, bet the market's gonna go up. And so it traps those people, but also people that are maybe in a larger trade that have their stops up here, that are already betting, people that are in maybe a bigger time frame trade that have their stop losses above this high before. Well, it comes up here, knocks them out of their trade, and then goes back down. Essentially, it's liquidity hunting, some people call it. And from there, it sells off, starts to kind of go sideways, it loses that steam, and then the big picture eventually plays out and it pushes lower. And you can see it kind of happened here again. And so that's why I don't like to discount something when it's broken like that. And so if you combine these concepts of the highs and the lows starting to slow down here and making lower lows and lower highs, just looking at the swings, that's showing you that the trend is slowing down, starting to shift. And if you combine that with the fact that you're already at a spot based on a supply and demand zone that you think the market's gonna slow down, well, that's just two good signals that, okay, well, maybe the market's gonna push lower here and I can make money betting that it's gonna go down. So I highly suggest you open a chart on NinjaTrader for yourself and practice looking for these concepts. It takes time to get used to reading a chart. Now that you've learned the skills to analyze the market, we can actually start leveling you up to understand how to take advantage of the opportunities the market gives you. Every one of these steps is what I wish I knew when I started. This is gonna be your shortcut. So step one of this process is looking for those key reversal zones. Just like we were talking about with those concepts before, you want to be looking at where the major areas in the market are that it's likely to reverse off of. This is the biggest key I found to finding those high probability zones, because if you think about it, looking at this, it's easy to see, okay, when the market comes up here, it's likely that it's gonna go down. But anywhere in the middle here, it's really hard to know what it's gonna do. Is it gonna chop? Is it going to sell off to the lows in some kind of fashion? It's hard to be able to consistently make profitable trades when the market is moving like this and you're trying to predict the direction it's gonna go, compared to when it's at an extreme. That makes it way more likely for it to be overextended and it needs to snap back in some fashion. And those are the high probability spots that you want to be scalping for. It allows you to jump in and jump out very easily at those swings and avoid all the crazy noise in the middle. And so a couple keys to this is, for me when I'm trading, I usually enter in on a 1 or a 5 minute chart. But to draw these levels, I look at a higher time frame of usually a 15 or 30 minute chart. This just allows me to kind of look at the bigger picture and focus on those key extremes in the market. Because sticking to those extremes is what is gonna make you more profitable. Trying to capture, like I said in the beginning, all those little swings in the middle is just gonna lose you money in the long run. Now, to draw these levels, I always suggest looking for two major swings. So you wanna see the market pop up and sell off from the same area twice before you look for a third time of it testing that and looking to assume that it's gonna go to the downside. Now, if we were mainly looking at a resistance or a supply zone, this totally works on the flip side too. If the market comes down here, I would look for a potential bounce off of this area as well. And so that's the nice thing about this is you can trade it in both directions. It doesn't matter if the market's going up or down for you to make money consistently. Now, the second thing is using a lot of those concepts that we talked about is trend analysis, is analyzing the trend as it comes into that major level. When it's coming down, let's say to flip it now, into a level that you've liked so far, when it's coming down into this, you wanna see, okay, what is the trend? Is there a downtrend in play? And when does that break? You want to only be looking for the market to potentially bounce off of this when you can see clearly that the trend into that level is broken. Otherwise, you're just gambling that it could bounce off of this level. It's so hard to know if a level is going to hold or not until you see the trend start to shift. And so some couple key things about that is, using those trend lines of just the basic swing highs and the swing lows like we talked about, of just keeping track of those. And then once those start to shift, once it goes from making lower lows and lower highs to now making maybe a double bottom or a higher low to making a higher high, that's when you can start to see, okay, it's starting to shift. And if that aligns up with a support level, that's where you want to be saying, okay, step 2 is now done. Now, step 3 is you start to essentially get more and more narrowed. As you can see through this process, looking at a chart is, the big picture is looking at, okay, where's the big major area where I want to wait for the market to come up and potentially reverse off of? And then the next thing is, okay, I want to make sure that trend essentially slows down before I get in short. And so the whole idea of this is, you can see it's kind of looking at the big picture and slowly zooming in. The first idea is, okay, I want to wait for this major level. Next is I want to make sure that the trend that goes into this level, I want to wait for it to slow down. I want to wait for it to stop making higher highs and higher lows and show me a reason to jump in that it's slowing down. The next part of that is looking at a candlestick pattern. And then the whole idea of this third step is essentially when it comes up to your level here, you're looking for that trend to break, and then you're looking for a candlestick pattern to help you confirm that, okay, this swing here, this push up is going to start failing. Because otherwise, how do you know in real time when this is going to form? It's easy to know after the fact. Once you can see the swings that, okay, well, it's clearly in a downtrend now off of this level. I should have jumped in here, right? Now, so how do you confirm right here that you are right there in real time before any of this has taken place? And so the whole idea with that is we're looking for a candlestick pattern at this area when the market's forming that. It's going to make a ton more sense in the live example that we're going to go over in a minute. But a couple of key things that you want to do with this is, first off, you need to not have a lot of chop going into this. To show you what I mean is, if we actually look at this spot on the chart we've been looking at, is right now moving up in this level, you can see it's starting to slow down, but there's a lot of chop back and forth. Right? If we look at, say, hey, this was maybe a swing high in real time, if we're gonna say this is a swing high up here, and I actually think that right here, well, it's technically made a lower high. And that could be a confirmation of, okay, I wanna jump in. But overall, going into this, and even moving a little bit forwards to this one right here, it's been kind of choppy back and forth. It's better to wait for it to be a lot clearer of moving into this level, making a high, and then starting to sell off. If you have a ton of candles that are just kind of stacking up and not making that much movement vertically, it's showing you that the market's kind of at an equilibrium, and it's more likely to start to chop around for a while before it gets moving. Versus if I compare it to this guy over here, the market here, it did chop for a little while and hit equilibrium, but because of going into this level, it had crazy moves up into this with very little chop at that level. Versus the last one, it was showing that it was overextended, and it's likely to kind of have that whip back. Now, a couple of key patterns I like to consistently use are a double top and a head and shoulders pattern. I've actually got a really sick PDF guide that you can download for free. I'll put in the link in the description of this video. It essentially has 14 pages of patterns that I use, theories of why they work, the reality of what they look like, keys to the pattern, and then actually things to avoid with the pattern of what can give it a false reading. And so I highly recommend you get that. It's totally free. You'll just find it in the description of this video. That'll really help with identifying those major patterns And as well, the fourth step now is looking at candlestick confirmations. This is kind of the last step of jumping into a trade. And all of this will really make a lot more sense when I show you this real trade example we're gonna go over in a minute. But the main things to look for this is, again, you wanna avoid that chop still. You want clear candlestick strength. Two major patterns I like to look for are either engulfing candlestick patterns or the 3-line strike patterns. And so if we actually go to another page from that guide that you can get down below, is the 3-line strike pattern. Essentially what it does is, the whole idea is that the market's kind of moving up methodically. The candlesticks are looking kind of roughly the same size here. And then all of a sudden you have a massive bearish candlestick that is huge compared to the previous candlesticks. What that shows is a lot of strength. This is essentially the final confirmation that, okay, the trend is up, but I'm looking for it to, fail at this resistance area. We've had the lower lows and lower highs. And so once I see kind of this candlestick, it shows that the momentum is switching and that it's likely to continue down lower because of these bigger picture factors that we have aligned up to essentially create a domino effect of entering into a trade and finding a high probability setup that is likely to work out. Now, the final step for this is actually entering in the trade. When it comes down to actually entering in the trade and you see all this stuff, a lot of emotions come up. It's scary. And so I want to give you the tools, and we'll definitely do this a lot more in the live example here in a second, of how to do it properly. Now remember, I haven't gone over trading math a ton in this video, but stick to a positive risk reward ratio where you're risking $100 to make something either like $200 or $300, because it allows it to where if you're wrong, it's not that big of a deal, because every time you're right, and even if you're right 50% of the time, these profits that you make when you do win outweigh the losses that happen. And so over time, if you take something like 10 trades, 100 trades, you'll consistently be making money on average. Now, a couple of things to think about. The biggest mistake that people do when actually entering into a trade or managing a trade is they will increase their risk during the trade. They'll kind of get married to the trade. Essentially, they'll, enter in here and they'll put their stop loss down here. And so the market kind of goes here, they enter in, it goes up a little and it comes down. And what they do is they move their stop loss further away because they think, okay, well, I still think it looks really good. I know, it just needs a little more room, right? And what that does is it increases your risk to, let's say, $200. And now the math up here, you've totally ruined by doing that. Now, you don't know what's gonna happen to one trade. It can be the best looking setup you have ever seen. The stars can be aligning. You think it's gonna be a massive home run and some random news could pop out, some politician could say something, the market could just bleep lower real quick. That can totally happen and you'll have lost more than you should have and really blown up the whole process that trading is. And so this kind of goes along with plan your exit before entering. You need to have a plan of when you're jumping in a trade right here, where is your stop loss gonna go? And where is your take profit gonna go? Is it gonna be a fixed profit target based on just going for $200 or $300? Or is it gonna be something that you slowly manage over time? This is very, very important to know before you jump into the trade. Otherwise, you're gonna make emotional mistakes like moving your stop loss further down or tightening up your profit target and getting out of this trade way earlier than you should have because you got scared that, well, I just want to get out. I want this thing to work out and I just want to kind of be done with it. It's really frustrating. That's kind of things that will run through your head as you're in a trade. Now let's take these concepts and let me show you exactly how I entered a real money trade this morning using this checklist and analyzing the market in real time with the concepts we've used. It's easy to find these after the fact, but if you watch how I actually analyzed and entered this trade, you'll see how it's possible to spot profitable moves before they happen and take advantage of them. So first thing that I do every day that I come into trading, I open my charts to the larger time frame and look for those big key levels. And so today I was watching oil futures and I was looking at this major swings that we've had in it. Essentially, the market's bounced here twice already. And so I liked this area for a potential bounce. This was looking at a 30-minute chart here. And if we look at a 15-minute chart here, it's pretty much the same. It's come down, bounced here a little bit, and then come back down to test it again. And you can see it's actually done a failed breakout here. And so that's where my step one was taken care of. I looked at, okay, this is a major level I think we're likely to bounce off of. We have a big trend if we look into this area where the market's come down here and it's clearly going sideways at this point. You know, the highs here are roughly the same, the lows here roughly the same. And so to me, that signals that, okay, this downtrend is over. We're at this area. And so I think it's likely that those two factors are gonna help potentially push us higher, big picture. And so that's pretty much step two of analyzing the current trend. Now, one last trend factor is once I zoomed into a 5-minute chart, I sometimes enter in on a 1 minute or a 5 minute. For me, I've noticed for oil, 5 minutes is a little better. 1 minute is a little too choppy. It doesn't move as fast paced as some other charts that work with a 5 minute. But if we look at this big move down right here to continue to analyze the trend, this is a move I love to see, because what this signals to me is that the market has made a really fast move down here. And so likely it's overextended. It's not a healthy move. If I could kind of look for another one here, as you can see, the market moves down here very quickly, and then it had to essentially snap back to about 50% of this move. If I pull up actually a Fibonacci tool here, take the high here of this swing and the low here, the midpoint between those is right here. It's essentially at 50%. That is a very common spot I find where fast moves like this will pull back to. It's essentially a healthy retracement of the market saying, okay, I'm overextended. You know, people who have caught this move need to sell, and it's very likely that it's going to do that. And so for me, that is a great spot to think of, okay, well, if I look at this move here, we've made that healthy retracement already. And so that's not good in terms of if I'm trying to just capture this quick move from the lows back up. But in terms of it continuing lower, that's where it'll usually pull back before it continues lower. And so if it comes here, does that, and this continue lower fails, and it makes a higher low here than this one, well, that's a really good signal that it's going to continue higher. And so on a smaller time frame, you know, smaller picture, that's kind of this pattern playing out. And then hopefully, you know, if you look at the bigger picture, is that the larger pattern of bouncing off the support level will play out too. And so if we move on to step 3 now, we want to be looking for a nice candlestick pattern. And so what I like to look for a lot of the time with these situations is essentially that higher low being confirmed there or a double bottom. And so if I actually pull this up in real time now, this is my chart getting recorded from this morning. And so essentially at this point, this is where I'm thinking, okay, I want to see a large candlestick here form, because that's going to help me with step 3 and 4 basically. It's going to show me a double bottom, and then it's also going to be that strong engulfing candlestick that confirms that. And so right here you can see I'm using essentially a tool to say, okay, if I enter here and my stop loss is here, how much do I want to enter in on the trade? And then where is, you know, my risk reward ratio is going to be. And so essentially, once I wait for that to confirm, I like to let the next candlestick play out a little bit, because sometimes a big candlestick like that can have a little bit of a pullback before it keeps going higher. Minor detail, but essentially what I'm looking for now is, okay, I'm going to enter in long at the break of this pattern and as it goes higher. And so what I do is, you actually see there's no order here on the screen, but I've entered in a long here and put my stop loss down here. The only reason why it doesn't show up is actually just because My account on this recording screen wasn't selected for a little while, but if we zoom forwards, you can see I entered in here and I put my stop loss below here, essentially the bottom of that swing. The whole idea of why I put my stop loss there is because I don't want the market to, if the market comes up here, makes a pretty clean higher low, and then comes up and breaks that, I think the trend's gonna continue lower. And so I just want to kind of get out because I'm getting mixed signals. I want the signals for the trade to be clear and for me to jump in on the trade. And so with this trade, I think I'm risking about $800. And so as we move up, I'm looking at a few key factors to manage it. Now, before I show you how to manage this trade, pause and think, where would you exit this trade based on what you know so far about market structure? All the concepts I've taught you in this video, I use them to manage my trades in real time. Now, if you actually pause and critically think about this, you're already doing what 90% of traders won't. And so to walk you through how I plan to do this is, well, obviously the major swing I'd love to go for is somewhere up here. That would be holding overnight, multiple days. And that's not really what I was looking for today, especially because it's a Friday. It's going into a long weekend actually with a holiday on Monday. Now, obviously you didn't know that, but just looking at the patterns here is, well, the market's starting to kind of slow down. And so there's potential resistance zones here where I think the market could slow down. I also think a big picture, kind of more looking at a 30-minute, is if we look at this, well, the major kind of swing down it had when it started to accelerate was kind of this area right here. And so I would think a good spot would be to give back up to here if it really started to get going. And so that's essentially what I'm doing every time I'm in a trade, is I'm thinking about where are the potential for not necessarily major, you don't necessarily need to be targeting a major swing or a major supply or demand level, but also looking at these smaller ones, because now that we're in a trade, those can still reverse the market. They're not necessarily where I want to enter in on the market, but they are at a spot where I want to potentially get out or take some of the trade off. And so right here, you can see as the market started to push up here, it's had a really nice move. It's essentially given up this major move down. I have moved my trade to break even. It's really important to take that risk off the table, because going forwards, well, I don't want it to come up here all the way down and I actually end up losing $800 on the day when I was up over $800. That's just kind of, math-wise, you gotta kind of go with that. And the helpful part is it had this little micro pullback here. That's when I kind of moved it up. And then from there, in a minute here, I put in a limit order at this high here because I wanted to say, I don't want to manage it in real time. I want to just get out of half of my trade of one of my contracts out of my two when it punches up to this level. And so right there, you can see it closed. And so I closed off, took about half of my profits there. And then with the idea is that I'm buying at the major support here. I want to see if this will continue higher and I can get even more out of this. But I don't want to be greedy. It's at a definite spot where I think it can slow down. And so I want to take some off. And so that limit order that just showed up there, I put it up here in case we did just skyrocket up there. That was the spot I wanted to take the trade off. At that point, I would have been super happy. I think it would have been 4 times my risk in terms of profit, at least for half of that trade. But going back to the concepts that we talked about, you can see I have a trend line here. And this upwards trend that is going on here is a very unhealthy or one directional trend. And so my thought is I'm okay holding this as long as it holds this trend line. But as soon as it kind of starts to break that, it could pull back in a big way. And at this point, I'm thinking that, hey, this is a great move. I don't want to hold through a big pullback and push higher. I wasn't able to break up my trade into maybe having a smaller amount on here. And so at this point, I was essentially just watching this and saying, okay, I'm gonna get out. And so just to zoom forwards here, is it had a little bit of a bottom here, moved my stop loss up there, and then it eventually broke that right there. And so that's how I take this whole process and turn it into a step-by-step checklist that you can now use for yourself. And so you now have unlocked all these concepts and this checklist to be able to attack the market every day. Now it's your turn. Start analyzing these patterns and practicing trade setups using NinjaTrader. Use what you've learned to spot opportunities and build confidence as you go. And if you want a more in-depth breakdown of this scalping style with more examples, check out this next video. It'll take you even deeper into this strategy.